Everyone makes mistakes when it comes to investing, and even Warren Buffett, the greatest investor of all time, has acknowledged making numerous blunders over the course of his long career. Making mistakes is common, and you will do so as well, but you may learn from both the good and the terrible things people do when investing by watching how they behave. In this video, we'll explore some of the most common mistakes people make while investing in the stock market. To avoid repeating these easy mistakes yourself, make sure to watch the entire video. Mistake number 1. Lack of diversification. Diversification is the practice of investing in a variety of different asset classes, industries, and geographic locations in order to spread out the risk and reduce the impact of market volatility on your portfolio. You can lessen your exposure to the volatility of any one asset or market by investing in a variety of assets. You run the risk of becoming sensitive to market volatility and suffering substantial losses if you don't diversify your investments. For instance, if you put all of your money into one company or sector, and that company or sector goes through a slump, you could lose a substantial amount of your investment. Similar to this, your investments may suffer if you put all of your money in one place, and that place goes through political or economic unrest. On the other hand, you can lower your overall risk exposure and possibly generate more steady investment returns by diversifying your investments across several asset classes, industries, and geographical locations. You can lessen the effect of market volatility on your portfolio, for instance, by investing in a variety of stocks, bonds, commodities, real estate, and other assets. Mistake number 2. Emotional investing. Emotional investing refers to the practice of making investment decisions based on feelings and emotions such as fear or greed, rather than on sound analysis and rational decision-making. Investors may make fast and irrational decisions that harm the performance of their investments when they base their decisions on feelings rather than rational analysis. For example, at times of market turbulence or economic unpredictability, investors may sell off their holdings out of fear, even if the investment's fundamentals are still strong. This may result in lost chances for long-term gains, as well as possible losses if the investor sells at a market low. Similar to this, excessive risk-taking by investors in speculative or high-risk investments that promise big returns can be brought on by greed when they fail to completely comprehend the dangers and drawbacks involved. If the investment doesn't perform as predicted, or if market conditions change, this could result in large losses. Mistake number 3. Timing the market. Timing the market is the practice of trying to time the purchase and sale of stocks based on brief market swings in an effort to profit from or protect against brief losses. This method entails making future market predictions which are notoriously difficult to perform with any degree of accuracy. For a number of reasons, trying to time the market can result in lost chances and substantial losses. First of all, since there are so many variables that might affect stock values, such as prevailing economic conditions, current political events, and company-specific news, it can be challenging to precisely forecast short-term market moves. Second, trying to time the market necessitates frequent trading, which may incur greater commissions and taxes. Additionally, frequent trading may result in missed chances if an investor sells a stock too soon or fails to buy one at the correct time, both of which could result in lost profits. Finally, trying to time the market might result in investors making emotional choices as they may feel pressured to buy or sell stocks based on short-term market fluctuations rather than long-term investment goals and techniques. Mistake 4. Not doing enough research. Failure to conduct proper research on certain businesses and industries can result in bad investment choices and expose investors to fraud and scams. It's crucial to do extensive study on a company's finances, business model, competitive environment, management team, and other aspects before investing in it or a related industry. Poor investment decisions can result from a lack of sufficient research in a variety of ways. An investor, for instance, might make an investment without fully understanding the risks and potential drawbacks, which could result in unforeseen losses. Similar to this, if an investor does not recognize high-growth businesses or developing industries, they risk missing out on possible opportunities. Mistake 5. Ignoring fees and expenses. Over time, reduced investment returns can result from not paying attention to fees and expenses related to investment products, since these costs can reduce investment gains. Transaction costs, management charges, and other costs related to purchasing, holding, and selling investments are some examples of investment fees and expenses. Ignoring these costs could harm investment performance for a number of reasons. First, costs can pile up over time and be relatively costly, especially for actively managed investment products. For instance, a mutual fund with a 1% expense ratio might not seem like much, but over the course of several years, the fees might mount up to thousands of dollars. Second, fees and costs can affect investment returns in a compounding manner. Long-term investment performance can be significantly impacted by even little variances in fees and expenses, especially when compounded over a number of years. Third, neglecting fees and costs might result in investors making less than ideal investing choices. Investors may, for instance, be drawn to investment products with cheap initial costs or commissions, but these products may have higher ongoing fees and expenses, which may eventually cut into investment earnings. Mistake 6. Focusing on short-term gains. Investors frequently make the mistake of concentrating on short-term rewards rather than long-term investment goals. Because they offer a quick return on investment, short-term gains are frequently tempting. Nevertheless, this approach can result in a lack of patience and discipline, which over time can lead to poor investment performance. Second, concentrating on short-term gains might result in investors losing their discipline as they become more vulnerable to market timing and other dangerous investment techniques that can harm the performance of their portfolio as a whole. Due to investors becoming too optimistic or pessimistic depending on short-term market movements, this can also lead to emotional decision-making. Lastly, concentrating on quick profits can make investors forget about their long-term investment objectives. A portfolio that is poorly diversified and out of alignment with the investor's risk tolerance and long-term financial objectives might arise from this lack of concentration and direction. Mistake 7. Overconfidence. Overconfidence in your ability to make investments might result in poor choices and perhaps substantial losses. Overconfident investors frequently overestimate their skills and neglect crucial aspects including market trends, the state of the economy, and firm fundamentals, which results in poor investment choices. Overconfidence can be harmful to investment success for a number of reasons. First, overconfident investors may think they have superior understanding of the market and insightful opinions that are not supported by solid research or evidence. If the investor's presumptions or analysis are incorrect, this might result in overconcentration on a single stock or industry, which can be dangerous. Second, overconfidence might cause investors to make snap judgments about their investments that are not supported by thorough research or long-term investment plans. This may lead to repeated asset purchases and sales, inflated transaction costs, and probable missed opportunities for long-term growth. Finally, overconfidence can cause investors to ignore crucial aspects including market trends, the state of the economy, and company fundamentals. For instance, overconfident investors could disregard warning indications of a market or economic collapse, resulting in a poorly diversified portfolio that is susceptible to sizable losses. That's it for this video. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon.